Welcome to the Pro Ticker Deep Dive. Okay, so we really need to unpack something that honestly seemed to fly completely under the radar last week.
Yeah, everyone was understandably focused on the Fed, right?
Exactly. Glued to the Federal Reserve's latest moves, that risk management cut everyone was talking about. But while we were all tracking the dot plot shifts, two really huge, structural agreements got signed between the U.S. and Japan.
And these aren't small deals. We're talking major financial and investment covenants.
Covenants that could really reshape how global capital flows, maybe for the next decade.
That's exactly what we're diving into today. Japan has committed a massive $550 billion in investment into the U.S.
Wow.
And tied to that are some really unprecedented agreements about financial transparency.
So for investors, this story feels, well, bigger than just the next rate decision, doesn't it?
Absolutely. It's about a fundamental shift in how allied capital is being deployed, a tectonic shift, really.
Which sets up the big question for you, our listener. If you have $500 billion of Japanese capital being structurally channeled into U.S. assets, what does that mean?
Does it automatically strengthen the dollar? Does it put this relentless pressure on the yen?
Or is this maybe less about pure economics and more about geopolitics, like a strategic chess game played with capital flows and control?
We're going to get into the mechanics because that's key here. How can this flow be so huge, but also kind of invisible at first?
Okay, let's start there. The fine print. These two agreements, finalized September 2025. What's the first one?
The first is the finance minister's joint statement. Think of this as the governance piece.
Governance.
Yeah, it basically says Japan has to disclose its pension fund holdings and its foreign reserves data under much stricter, more detailed transparency rules.
So no more vague numbers. Washington wants the full picture.
Essentially, yes, they want to see the whole spreadsheet, you could say.
And that transparency deal enables the second agreement.
Exactly. It's the prerequisite for the big one, the $550 billion investment memorandum.
And this isn't just Japan handing over cash, right?
Yeah.
It's targeted.
Highly targeted. The money is specifically earmarked for critical U.S. projects. We're talking semiconductors, advanced manufacturing.
Things like energy pipelines, too, for energy security.
Precisely. Energy pipelines and also foundational R&D in fields like AI, quantum computing, the next generation stuff.
Okay, but here's that flow paradox again. If you announce a $500 billion commitment, which sounds like it needs yen converted to dollars.
Where's the explosion in USD JPY? Why didn't the FX market just react instantly?
Right. Why wasn't there some massive yen dump lighting up the trading screens?
And this is where the technical details are really crucial for traders to understand. It's not like a single giant auction.
Okay.
Officials have been quite clear. The financing is designed to avoid massive direct spot market exposure.
How do they do that?
It's structured. They're using things like credit agencies, complex cross-currency swaps, and importantly, dollar-denominated bonds issued by Japanese entities themselves.
So if a Japanese pension fund buys a U.S. project using a dollar bond they issued.
The conversion risk is managed differently. Either the issuer handles the yen to dollar part, or it's hedged using derivatives over a long time.
Like a swap.
Exactly. In a swap, they can get the dollars they need without having to go buy them on the spot market right away. It smooths things out.
So the structure prevents that immediate shock, that huge volatility spike we might have expected.
Yes, it dampens the short-term drama for FX traders. But, and this is key, the underlying direction of capital is crystal clear.
It's a structural flow towards U.S. assets.
Locked in, a tailwind that provides demand for years to come.
Let's put this in context then. What's the bigger picture, the macro environment?
Well, on the U.S. side, you had the Fed with that 25 basis point cut, the risk management one.
Yeah, growth forecast may be ticking up a bit, but the easing cycle looks slow, right? Maybe rates settling around 3%. Still restrictive.
That's the idea, a measured pace. This maybe creates a slightly softer bias for the dollar than in past easing cycles,
Right.
but the U.S. still has this huge fiscal deficit. It needs constant, predictable capital inflows.
So Japan's $550 billion commitment isn't just like friendly support. It's strategically important for the U.S. balance sheet.
It becomes a strategic necessity, ensuring that long-term funding stability.
And what about Japan's side? What's their situation?
They're facing some headwinds, a persistent trade deficit, export volumes to the U.S. are weaker, partly due to those tariffs.
Reciprocal tariffs, yeah.
Yeah.
And some political instability domestically, too.
A bit of that, too, yes.
Yeah.
So in that context, committing $500 billion externally,
Seems less about immediate profit and more about something else.
Exactly. More about strategic security, strategic alignment.
So the $550 billion is the price of that alignment.
You could see it that way. And Washington is using this moment, maybe Japan's relative weakness or challenges, to really push hard on that transparency piece.
The detailed reserves disclosure.
And we're not just talking about how many dollars they hold. They want the details on currency positions, forwards, complex derivatives, the works.
Why such a push for detail?
If you zoom out, this push for a clearer scoreboard, as some put it, it looks like the U.S. tightening its grip.
Tighten its grip on how allies manage their money.
How key allies manage and deploy their sovereign capital, yeah. It feels like a deliberate move to protect the dollar's reserve status in a world that's, well, becoming more complex, more multipolar.
Transparency equals enforcement, basically.
That seems to be part of the calculation.
Okay, if this is about control, then Washington needs eyes on the biggest players. Which brings us to Japan's Government Pension Investment Fund, the GPIF. The GPIF, it's a behemoth, one of the world's largest capital pools, a real market whale.
And they're crucial because they have this huge global mandate, and specifically a target allocation of 25% for foreign bonds and equities.
25%. Managing that gives them enormous influence.
Massive structural influence. And these new agreements, particularly the transparency part, explicitly state that these pension funds, they must invest for diversification, not exchange rates.
Yeah. So Washington is drawing a line, saying, you can diversify, but don't use this massive firepower to secretly mess with the yen.
That's essentially the message. Don't use this as a stealth currency manipulation tool, even if diversification naturally leads to a weaker yen.
The transparency agreement is the check on that. Make sure flows stay aligned with U.S. interests.
Precisely.
This raises a really interesting point then. If the mechanisms are built to protect the short-term FX market, and the rules try to limit long-term manipulation, where did that leave the typical FX trader? I mean, if capital allocation is now driven so much by these strategic deals, not just rate differentials or inflation, are the old models kind of broken?
That's the shift you absolutely have to recognize, I think. The structural forces, the geopolitical angle here. It sets the stage long-term for U.S. assets.
Providing a base level of demand for the dollar.
A foundational bid, yes. Rate differentials still matter, of course, but this committed capital flow kind of overrides some of the short-term noise.
So it confirms the dollar isn't just propped up by the Fed.
But also by the strategic alignment and the capital flows of its major allies.
Okay, let's flip this. What are the upsides, the opportunities in these deals?
For the U.S., it's pretty clear. Targeted capital boosts high-priority sectors, semis, energy, AI, quantum.
And anchors long-term demand for U.S. capital markets generally. Keeps a bid under the dollar structurally.
Right. And it's not entirely one-sided for Japan either.
How so?
Well, think about the yen. If these structured outflows do lead to a gradually weaker yen, that actually helps Japanese exporters.
Especially automakers, electronics companies, the ones hit by trade friction.
Exactly. They've had a tough time with tariffs. A weaker currency provides a bit of a cushion, a needed boost perhaps, so the alignment has benefits there too.
But deals this big always have risks. Potential pitfalls investors need to watch.
Absolutely. Despite the current calm appearance, there are at least 3 critical downside risks.
Okay, what's the first one?
Market suspicion. This links back to the GPIF.
That 25% foreign allocation target.
Yes. If their published data starts showing allocations creeping right up to that limit, say 24.5%, 24.8%,
traders will get nervous.
Instantly suspicious. They'll think, okay, this isn't just diversification anymore. Maybe they're trying to influence the yen.
And that could trigger volatility, a squeeze against the dollar.
Exactly. It signals the potential start of manipulation, breaking the spirit of the agreement. Big volatility risk there.
Okay, risk number 2.
U.S. tolerance. Or maybe the lack thereof. There's an underlying tension.
What happens if the deal's goals collide?
Think about it. If the yen weakens too much, too fast, Japan might feel pressure to intervene to stabilize it.
And the main tool for that is often
selling their holdings of U.S. treasuries. But Washington relies on Japan being a massive holder of U.S. debt.
So the U.S. might object if Japan starts dumping treasuries to prop up the yen, even if it's their ally.
There's significant political risk there. Would the U.S. tolerate a major ally selling T-bills aggressively, regardless of this investment deal? It's a potential flashpoint.
Okay. And the third risk.
Execution risk. That $550 billion number sounds incredible, but remember,
It's not arriving all at once.
no, it's spread over years. It flows through complex financing vehicles tied to project timelines, credit agency work.
So the actual cash hitting the U.S. might be slower, more inconsistent than people expect?
Much slower, potentially.
Yeah.
If the actual dollar flow lags expectations, that could definitely dampen market enthusiasm for U.S. assets tied to this deal.
Got it. Okay, let's bring it down to the trading floor. What's the technical view for dollar-yen traders watching this?
Given the structured flows and the macro picture, consolidation seems the most likely path for a while.
Oh.
Yeah, look for the pair to probably stay within, say, the 148 to 152 range. That seems plausible.
And resistance.
Still looks pretty solid up near that 152 zone. Breaking convincingly above that would need a really big catalyst.
Like what? A total collapse in Japanese inflation data? Or maybe the Fed suddenly turns super hawkish again?
Something like that, something that completely changes the current assumptions.
And on the downside, support levels.
First key support to watch is around 146.50.
Okay.
Below that, you're looking at 144 as a kind of psychological floor. But getting through there would likely need a big surprise.
A surprise, like a super dovish Fed move, or maybe a headline about Japan breaking those transparency rules.
Exactly. That's the headline risk. And a warning here. Positioning in yen is often crowded. Any major surprise.
Could spark a really sharp yen squeeze.
A violent squeeze. So traders absolutely need to brace for potential headline risk around this whole story.
Okay, so let's synthesize this. What's the final takeaway?
The core point is that these deals really changed the conversation around the dollar. Yes, the Fed's slow cuts might suggest some gentle downward pressure,
Right.
but these huge structural inflows from a key ally like Japan act as a powerful counterweight, a foundational support.
It's about managing capital flow to support the dollar's global role.
It seems to be the flow of global capital is being actively steered, you could argue, to protect dollar dominance.
So the final thought for you, the listener. When you're analyzing dollar-yen or even broader global markets, you really have to think beyond just the next central bank meeting now, because these agreements hint at a world where geopolitics, these big strategic deals, are increasingly setting the long-term market trends, sometimes even more than the immediate economic data points.
That's the deeper game potentially being played out.
See you all in the next ProTicker Deep Dive.